Hello, and welcome back to our second transactional video. Remember, in this video, what we're doing is we're going through a number of transactions that we're always going to see, normally, we're always going to see in an accounting problem or even out there in the real world. So in the previous video, we went over an owner investing cash into his own company. And then the second one we hit was prepaying for an asset, right? Whether it be rent, supplies, whatever. So the third type of transaction that we're most always going to see is when a company purchases an asset on account, okay? So this third transaction says that on January 3rd, okay, Acme Company, Acme Company purchased $2,850 of office supplies on account. Okay? When you see on account, it is always going to be a payable, right? For the most part, it's always going to be a payable. But we need to look at who is doing the paying and who's doing the receiving, right? Remember, we said that an accounts payable means that we got something, we owe somebody money in the future, right? In this case, we got office supplies, but we're going to pay our supplier sometime in the future, right? If we sell something on account, well, we provided somebody with an asset or service or whatever, right? We provided somebody something. And if we say we sold on account, that's always going to be a receivable, okay? So anytime you see purchased on account, guess what? It's going to be a payable, right? So remember, we're taking a picture, pulling it apart, and putting it back together in accounting words, okay? So just by reading this, January 3rd, Acme Company purchased $2,850 worth of office supplies on account. So what's going on? Well, from the accounting equation standpoint, we could say that we are increasing an asset and we're increasing a liability. Okay, great. So I got the analysis right of what accounts are going to be, what side of the accounting equation is going to be hit. Now what I need to do is I need to pull out my accounts. Remember, there's always has to be at least 2 accounts within each transaction. I need to determine what the dollar amount is, and then I need to figure out which account gets debited, which one gets credited. Okay? So I'm going to go ahead and do the journal entry here. Remember, we're always skipping spaces in between the journal entries. So on January 3rd, I purchased office supplies on account. I already know I hit an asset. What is the asset that I'm hitting? Well, it's supplies or office supplies. So I'm going to type in office supplies. Office supplies is an asset. I know my asset's going up. In order to increase an asset, I must debit it. So I'm going to debit office supplies for $2,850. Well, I already recognize that a liability is going up. What liability is going up? Well, it's my accounts payable. Okay? How much is my accounts payable going up by? $2,850. How do I increase a liability? I increase a liability with a credit. So I need to indent my credit. I'm going to type in AP. That's abbreviation for accounts payable. And I'm going to enter my credit amount $2,850. Okay? What did I do here? What's my explanation? Well, I need to italicize my explanation, and I'm going to say bought supplies on account. Okay? Skip a space. Always skip a space. So what's the next transaction that more often than not we're always going to see? Well, we're always going to see, normally, through the normal course of business, we're always going to see maybe an owner signing a bank or signing a bank note to get cash. Okay? So let's just say on January 4th, Acme Company obtained a 2-year bank loan for $36,000 by signing a note payable. Annual interest is 10%, due on each November 30th. Okay? Now, we got a lot going on here, okay? Let's focus in on what we have to do. First, we have to analyze the transaction. What's happening? Well, I'm signing a bank note. What is a note? Well, a bank note is a note payable, right? I don't even have to know that because the transaction tells me, hey, you signed a note payable. Notes payable are a liability. Liabilities go up. Well, what am I getting? Well, if I'm signing a bank note, obviously the bank's going to give me cash, so my cash has to go up. So cash and liabilities are both going up, okay? Now I need to identify my accounts. Well, we already did that, right? By analyzing the transaction, we know that I'm getting cash and I'm going to have a note payable. So how do we do that? Well, very simple. We put in our date. January 4th. What's my debit? Well, I'm getting cash. Cash increases. Cash increases. I increase an asset with a debit. Cash is an asset, so I have to debit cash to increase it. So I'm going to debit cash for my $36,000. What am I going to debit, or what am I going to credit? Well, I know the credit amount has to be $36,000, right? Has to be, because debits and credits always have to equal. So what then am I going to credit? Well, I'm going to credit a liability, right? Because I know my liability account gets hit. I know I have a notes payable. I know a notes payable is a liability. How do I increase a liability? With a credit. So I'm going to indent. I'm going to come up here and hit my increase indent button, and I'm going to say notes payable. And I already got my $36,000. Now, notice it said annual interest 10% due each November 30th. Am I at November 30th yet? Not at all. I'm at January 4th. Do I owe, as of today, do I owe them any interest? Absolutely not. I just signed the bank note. I just got the money today. There hasn't been any time for interest to accrue. Okay? So what am I going to do here? Well, I'm going to type in my explanation. I'm going to italicize it by clicking the italics button right here. And I'm going to say signed a 2-year $36,000 note. And I'm going to say 10% due 11/30. So that way I can read this transaction and I can know that, oh, okay, on January 4th, I got cash by signing a note, so I have a liability and I have an asset. It's a 2-year note. I'm going to owe 10% interest, and I have to pay the interest on November 30th. Okay? Skip a space. Always skip a space. So what's the next transaction that I could possibly have? Well, more often than not, there's always going to be a business that's going to buy assets, right? That asset could be equipment, it could be inventory, it could be supplies, it could be whatever, right? So almost always I'm going to see a transaction that's going to say something like, hey, the company purchased blank amount of equipment, okay? Or of office equipment, whatever. Bought a truck, bought a car. It's some asset that they bought. So let's say, for example, that on January 5th, Acme Company used cash to purchase $32,400 of office equipment. Okay? What's happening here? Well, I got to analyze the transaction. Well, cash is an asset, right? I used cash, or I paid cash, so my asset is decreasing by $32,400. What did I get for spending that cash? Well, I got office equipment. Office equipment is an asset, so my asset is going up. My asset side is going up $32,400. Okay, so the accounting and transaction is imbalance. Why? Because one asset goes up, another asset goes down. Okay, so on January 5th, I need to make this journal entry. Right? I already identified and analyzed which side of the accounting equation is going to get hit. Incidentally, they're both assets. So, what two asset accounts do I need to identify? Well, if I just read that problem, it tells me everything I need. Cash, used cash, purchased office equipment. So I'm going to use a cash account and I'm going to use an office equipment account. Okay? How do I increase an asset? I increase an asset with a debit. I decrease an asset with a credit. What is happening to my cash? It's going down, so I have to credit that. What is happening to my office equipment? Well, I'm buying office equipment, so it must be going up. So I'm going to debit office equipment for the $32,400. I'm going to credit cash. Notice I already indented cash for $32,400. This transaction is completed. Debits match credit, debits and credits match. I'm good. I got to put in an explanation. What I do? Bought office equipment. Okay? I don't need to say bought office equipment with cash because I can look at this and say, oh, office equipment, cash. I had to have used cash to get that office equipment. Okay? Now, let's look at another possible transaction that I know you're going to see at some point in time in your career. There are going to be times when somebody pays us for services that we have yet to provide them. Okay? Meaning, we gave somebody cash and we expect a service in return at some future date. Okay? So let me give you the example here. On on, December 6th, or I'm sorry, January 6th, Acme company received $3,000 cash for services to be performed in the future. Okay? So I need to analyze the accounting transaction, right? So this is January 6th. What happened? Well, somebody gave me cash. Cash is an asset. So I need to, since I'm receiving cash, I need to increase my assets. However, I didn't give them anything other than a promise to provide them with something in the future. Okay? Well, that's a liability, right, on my books, because I now have to provide somebody some service. Okay? I got the cash. I did not earn that revenue yet. Okay? I will earn it when I perform the service. So we have cash asset increasing. We owe somebody something. It's not money that we owe them. We owe them a service. That is a liability. So my cash is going up and my liabilities are going up. We just analyzed the accounting equation. Okay? Now I need to identify three things. Which accounts are impacted by this? What's the dollar amount? And what are my debits and credits? Okay? Cash is going up. I read the problem. I don't even have to figure out what's happening because I just read and it's telling me what to do. You receive $3,000 in cash. Cash is an asset. Assets increase with the debit, decrease with the credit. So I need to debit cash for $3,000. Okay? What is my counterpart to this transaction? Meaning, what's the other part to this transaction? Well, I know it's a liability. But which liability? Well, unearned revenue is a liability. I got paid for revenue that I have not yet earned because I did not provide that service or I didn't deliver anything. So I'm going to indent for my credit and I'm going to type in unearned revenue for $3,000. Okay? So those are two transactions that you are most always going to see. Okay? Again, I said I was going to do these in 15-minute increments. We hit our 15 minutes. Remember, two transactions that pretty much every business does: uses cash to buy equipment and receives cash in advance of providing a service. Okay? When we come back, we're going to look at two other transactions that we're going to see. So thank you, and please make sure you tune in for that one.